Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
So thanks everybody for joining us for the episode 7 with our guest Paul. We appreciate everybody joining. If it's your first time here, we go through a series of interview questions. This edition is focused on passive investors. We like this to be interactive, so please ask questions as you have. And before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice. Introductions. My name is Marcelo Cazini. My background is in IT, project management. I have an MBA from Texas A&M University. I'm a certified project management professional. I'm a CCIM local member here in Houston, and I've completed all the CCIM trainings. I'm a multifamily investor, and I own and operate my own commercial real estate. And I'll turn to Claudia and Martin.
Yeah, we are Claudia and Martin Rubio. We are commercial real estate investors, and we are based out of Houston. And I'm a real estate professional. I also have a degree in architecture, and I have a lot of background in asset management overseas, where I was born in South America. And I hold an NAA, National Apartment Association certification. That's called Independent Rental Owner Professional. And Martin, you can go ahead.
I'm an IT security expert. I've been on the IT consulting side for over 25 years. I've built a couple of businesses around it. We have had some other businesses related to real estate, hard money lending, and consulting in general. We have started doing multifamily a couple of years ago. Actually, the slide is updated. We are general or limited partners in almost 800 units nowadays in different markets here in Texas and in Arkansas. And we also syndicate deals. We have syndicated our first deal a couple months ago here in Houston, 135 units. That's pretty much it.
All right, Paul, do you want to introduce yourself?
Sure. So I'm an electrical engineer by trade. I've actually had the same job for 16 years. When I got out of college, I started with a large construction company. I've worked around North America, but I don't work in real estate. I'm an engineer, and I work on large infrastructure projects here in Dallas. And I'm based in Dallas, but I have projects around North America. But in my spare time, I'm also an apartment investor. So I started that about 4 years ago, and I've so far invested in 7 deals.
All right, perfect. So with that, I just want to see what kind of people in the audience that we have. I'll just send a poll to everybody. So if you can answer, just spend a minute there. What's your experience? Are you brand new to real estate? Are you a single family landlord? Are you already a passive investor? And are you in a syndicator or a lead or individual owner? If you guys can answer that, I'll give everybody a minute. And this is all, nobody's tracking anything. It's all anonymous answering.
We're not monetizing this information?
All right, so we'll give another 10 seconds. Looks like we have 9 people already answered. So, all right, so it looks like most people here are passive investors. We have one person who's done lead syndication, so that's awesome. And so now I want to ask another question.
That's okay. Just turn it off.
And the next question I want to ask you guys is, what is your biggest challenge as you look for multifamily investment opportunities? Is your biggest challenge learning you're still learning the multifamily investment fundamentals? Is your biggest challenge finding a good lead, a good sponsor? Is it finding deals to invest? Is it learning how to evaluate deal sponsors? Or is it learning how to evaluate deals? So if you guys can answer that, that help us with the content and asking questions, and then hopefully Paul can, as he explained his method, he can kind of talk through it. So are you having the most challenge finding good syndicators, finding deals? Is it hard to evaluate the sponsor? Is it hard to evaluate the deals once you find them? I know a lot of people are getting a lot of deals through email, but does that make it hard for you to evaluate? All right, so let me just share the results with everybody. So it looks like it's a pretty even spread into finding good sponsors, finding deals to invest, and maybe evaluating the deals. So, all right. So with that, let's get into some questions.
Yeah, hopefully the meetup helps on those concerns. Both on the first one, it's really interesting that most if not all of us here are passive investors. So that this is very interesting to have passive investors learning about how other guys are doing it, how they're investing, what their criteria is. So that's very good. And then those concerns on the second question, hopefully we can address some of those here and make you more comfortable on how Paul in particular is picking deals and seeing how they perform. So let's get to it. Paul, thank you very much for joining us today. I know because of this other event at 7, we have a shorter meetup, so 45 minutes is a little bit quicker than our usual, but we'll try to get as much value out of it, and hopefully we can get you back a few deals down the road. So let's start with, you mentioned already your background, your professional background. Can you tell us a little bit more on how do you get from just doing that, just doing your 9 to 5, your W2 job? How do you get to real estate? What was the first approach you got, and if it was through multifamily or if it was through other paths like single family? How did you actually get to your first passive investment in multifamily?
Sure. Okay. Well, I started out as a landlord when I mentioned that my job has moved me around the country a bit. I used to be I was living in a condo in Boston in my hometown. And when my job sent me here to Dallas, I didn't want to sell it. So I kind of became a landlord, without, I guess they call it an accidental landlord. So I've owned this one property for many years, for 12 years now. And it wasn't the most successful thing. It didn't make me a lot of money for a while. And then eventually the neighborhood improved. It started making me more money. And, the rents went up, and I started getting enthusiastic about real estate. I said, maybe I could make a lot of money at this if I buy more. So I just started reading, like, how do people actually make money in real estate? Because so far I haven't been doing it. Just winging it isn't working. So I start reading, and everything I read, I read websites online, and everything I read says you got to network, you got to meet other people that are already successful at it. So I look at meetups. I want to start meeting people. How am I going to buy more properties? Whether it's back home in Boston where I know, or maybe here in Dallas. It turned out that Dallas is a great market for real estate investing, and a lot of parts of Texas are. So I go to all these events around town. You can go on meetup.com and search for real estate investing clubs and groups. I was going to one like every week, and at first I thought I would buy single families because it seemed like a fairly low entry point. You can put a $20,000 down payment on a $120,000 house. I mean, that's probably gone up since then, but at the time those were the numbers that worked here in Dallas. And but then one of the groups I attended talked a little bit more about passively investing and just becoming a partner in someone else's deal. And I thought, well, that sounds good, because rather than do all the work myself, I could just kind of find somebody that's already good at this instead of trying to get good myself and going through all the lumps and the hard knocks of becoming successful. Why don't I find someone that's already successful, and just help them fund their deal and kind of ride their coattails. So I found a couple groups. I actually found a group that started out that was they were buying single family homes as they didn't call it a syndication, but it sort of was. So I put $5,000 toward one rental single family home. And I said, well, this won't be a lot of work. And it made me a little bit of money. But I think the best lesson of all is I spent $5,000 learning that I should not invest in single families anymore. It just was such a, the tenant paid the rent, and then 6 months later we had to evict them. We found the new tenant, screened them, good tenant. A year later, they turned into a bad tenant, had to evict them. I mean, overall, we didn't make a whole lot of money on that one house. But thankfully, the market just raised the price, and we made money on the sale when we got out. And so I continued looking, and it turned out that you could, on a bigger scale, you can do a similar thing, but with multifamily properties. There's groups that, you can do a group purchase on a $4 million building and get 20 people to put in 50 grand. And I said, okay, well, I'm already familiar with that concept. But it turned out on a bigger scale, it just works a lot better. There's more economies of scale. You can have you just have professionals. I mean, running single family homes is more of a mom and pop operation, but running a 100-unit apartment complex, there you can get a professional firm that's very good at it, and they have licenses, and they have everything. It's just a lot more. You can really mitigate your risk a lot better. So as soon as I came across that concept, I said that is what I'm going to do. And I read up on it. Bigger Pockets is a great website if you're learning about real estate. That might be the #1 site I'd recommend to beginners. And then I started focusing on those meetups. I unsubscribed from all the single family mailing lists and stopped going to those clubs. And I think I left those groups. And so I started learning more about multifamily, and that's when I came across the mentoring group that many of you are familiar with, Brad Sumrock. But he's got a weekend event where you can learn all about it for not a lot of money. So I went to that, and I said, all right, this is definitely what I'm going to do. I got a little discouraged in the beginning because I realized I just, the buy-in point's like $50,000 instead of $5,000. So at the time I couldn't quite afford to do it, but I spent a couple months thinking about it and realized that I think I can do this in the next couple of years. So, so I networked with deal sponsors who were putting these deals together. And that was, so this whole thing started about 4 years ago. So, as in the past 4 years, I've been able to scrape up some more money, and now I'm in 7 deals now, but, it took me several years to get to a point where I thought I could afford that.
Okay, no, that's awesome. I mean, yeah, that's a great path to go through, single family, and to have the opportunity to get that learning that you didn't want to be there for just $5,000. That's great. Yeah. I know a lot of people that they got to multifamily after owning 20, 30, even more single families, and most of them made a lot of money and they were very successful, but they all wish they would have found multifamily earlier. So that's good to hear. So yeah. So how much do you think you had to rely on mentoring for that first investment? Do you think that was something that you were prepared for just from your previous exercises, or do you think to learn about multifamily that was needed?
I think it was worthwhile, because even though, I mean, when you join one of those mentoring groups, and they cost a bit of money, and some people question it when you can go online and read a lot of the same information free. But I just found that it was for the investment I made in that club. First of all, I viewed it as more of an insurance policy. For a couple $1,000s to join that group, I would lose way more money than that on one bad deal, investing $50,000. And then second, it got me, it really like compressed the learning curve. The information is out there for free, but how do you know which information is good and bad? And the ability to network with people that have already done the deals and meet them face to face and just be part of this circle, I decided that was worthwhile. I mean, what I've learned, I guess I could have learned it on my own, but I never would have happened as quickly. Like I think after 4 years, I'd maybe be in 2 deals instead of 7. So I think it got me to a point that I didn't think was possible in a much shorter amount of time. So what I tell people is, I think you should definitely consider one of these programs, but you should maybe check out a couple of them and decide which one you like the best, and don't join it immediately talk to other students and learn what they got out of it. And then if that resonates with you, then I think consider it. So yeah, I mean, I could have done it without the program, but I think it's been much better to do it. And I think some of the lessons I've learned, I mean, not every deal I've invested in has been successful, and I think I'm a lot better at understanding why than just learning on my own.
Okay, yeah, it makes a lot of sense. I think for what you said on compressing timelines, that's one of the main advantages. Yeah. Go ahead, Marcelo.
Did you focus on any particular market when you were trying to passively invest in your first deal? I know you mentioned you were in Dallas, but
yeah.
What?
I think, I was fortunate to live here in Dallas. There's so many deals done here in DFW that it wasn't a stretch to say, well, yeah, my first deal is going to be in my home market. I want to do a deal that I want to go see the property. I want it to be in a town I'm familiar with. So yeah, I mean, my first deal, it definitely had to be here. And I mean, fortunately I live here. So it wasn't like, if I had lived in Waco and I said, well, my first deal has to be in Waco, that then I might've had to wait a lot longer. But to be able to make the decision to do it here was a lot easier because I live here, and the amount of the volume of transaction here is it's one of the biggest multifamily markets in the country.
Yeah, absolutely.
So,
go ahead, Claudia.
no, I just wanted to ask Paul, how long did it take you to get your first deal or to just write your first check?
Sure. So I told myself when I joined this program, they have a whole training, a series of training webinars. There's like 18 of them, and they go on for an hour and a half. So I said, I'm going to watch all the trainings. I'm going to learn everything that this program has to teach me. And I'm not going to binge watch them all in one weekend. I'm going to spread it out so that I can actually learn it. I maybe watch 2 or 3 per weekend. So that took me a couple months to get through them all. And I said, I'm definitely going through all the trainings before I jump into a deal. In the meantime, I'm going to network with as many sponsors as possible so that they're sending me their deals. And I have a lot of deals getting sent to me. And then when I finished the training, I said, okay, I'm getting close to ready to invest. But I'm still not going to jump on the first one I see. I'm going to look at a couple of them and then pick the one I like the best. So that whole thing I joined the mentoring program in February, and I got into my first deal. I wired somebody the money. I think I made the decision on the deal in June. I finally narrowed it down. So that was 4 months later. I don't think I actually wired the money till July. So it was like a 5-month process for me before I could actually have the courage to give somebody $50,000.
That's a great advice because a lot of people might be rushing because they have the money, they want to put it somewhere, and they might get it and put it into something that is not the best option.
Yeah.
So tell us a little bit more about your first deal, like
Sure.
Location and that. What else?
So it was it was right outside of Fort Worth in Hearst, 78 units. With a sponsor that I had met actually I'd met this particular sponsor before I joined the program. So he's one of the first people I ever talked to. And and I thought I had a pretty good conversation with him that day. So maybe he's one of the people that made me feel comfortable joining this program. So I said, okay, if he has a deal, I think he's somebody I'd invest with. And turned out to be a really deep value add. The property was a disaster, which everybody likes those deals because they think they can be very profitable, but they're also risky. So, 78 units, owners really mismanaged it for like 10 years, kind of ran it into the ground. Great opportunity for a new buyer though. So we take it over, and it's just like, as bad as we thought it was even worse after we actually officially owned the property. Like, it turned out to be only about 60% occupied instead of 80.
Wow.
A lot of people in there weren't really supposed to be in there. They just were not, sometimes somebody sells a property, they try to put bodies in there because to make the property look better. They're not people that would have passed a tenant screening. But it turned out to be good because all the vacant units that were we could renovate them a lot quicker when there was nobody in there. But there was a lot of work that needed to be done. The renovations, the property manager was just starting their own construction division. So we were the first client, and it just was not good. I mean, I work in construction. Construction's a risky business. It's not just, you can't just put anybody on that. So they did not manage the renovations very well. So we ended up having to go to contractors, which was not in the budget because it just costs more to have an outside contractor than to do it in-house. So the property struggled. I mean, it was a value add deal. The sponsor warned us that it would be a year before we see any cash flow. And I listened, but I was hoping he was just being conservative, kind of under promising, he was going to over deliver. And, but it took more than a year. So it was even more challenging than expected. So what I tell beginners now is don't invest in a deal like that if it's your first one. If giving somebody $50,000 is a big deal to you, look for like a good, like a deal that's going to cash flow like from day one, because then you'll get a check in 3 months and maybe another one in 6 months, and it'll feel good. It's good for morale. So this deal was just every month we get the monthly reports, and there'd just be a lot of negative numbers. And there'd always be some story, some drama with the property management. As a 78 unit property, I kind of got turned off on properties of that size because you can only have 1 or 2 people, you only have a couple people on site. So if somebody, quits or gets promoted, then you have to hire a new property manager. And it just seemed to be, we were having lots of problems keeping somebody on staff. So there were a number of issues. Ultimately, I mean, it ended well. I mean, after about a year and a half, the property finally got stabilized. And then we sold it, we got it up, and then we found a buyer right after that. And we sold it, all in all, we sold it in a little under 2 years. We made 85% on our money. There was no cash flow the entire time. It all came on the sale. So it was a successful deal, but it was a tough slog to get there. I think the sponsor really earned it. So it was just something that it's actually, out of the 7 deals I've invested, it's the only one that sold. So I hope they all turn out like that. But, you don't really know until it's over that how it's going to be. I mean, now that it's over, I wish I put more money in it. But during the, there's a little addendum to that story. So I invested $50,000, but the sponsor knew that it was my first time, and he decided he didn't, he was maybe a little bit oversubscribed. So he asked me if I wanted to get in for only 25. So I was kind of like, I'm already comfortable with the deal. I already did a lot of work to get happy with the deal. So, if you don't need the money, fine, send it back. But I'm okay with 50. So he gave me half back. And so I only invested 25. And when the deal struggled, there were times where I was glad that he reduced my investment. Now that it's over, I wish I put more in,
That's a good story.
When he pitched the deal to you, what were the expected returns in 5 years?
It was about it was 100% return in 5 years, which was what everybody was aiming for at that time in 2016. Today, hardly anybody underwrites a deal for that. You just wouldn't be competitive. Today, everybody's going for maybe 80% or 90% if you're lucky. So it was something like, once it got stabilized, maybe 9 or 10% cash flow and a total return of 100%. But he also told us that, like, if things go well, if the market is still good, we can probably sell or refinance in a year or two. So it wasn't like, we didn't really project a 5-year hold. I mean, it was just one of those things, like, if we had to hold it for 5 years, we could, but it was that type of property. We got a bank loan. It was a recourse loan just because it would not have qualified for agency debt. It was, it was under 90% occupied, so many problems. So we got a 5-year recourse bank loan. So we kind of knew that we'd be selling it in under 5 years, and preferably 1 or 2. But he showed us pictures of, there were units that had been burned out like 10 years ago, and the owner never bothered to fix them up. So you think, like, a unit that's been empty for 9 years and it would have rented out for $900, just do the math on all the money that they left on the table. So it just, when you see all the problems, you think, like, well, a good operator can make a lot of money out of that. And that's what was going through my head.
Yeah, for sure. So we have a question here from Jay that he sent directly to me, So he says he doesn't have a problem as a passive investor, but he's trying to co-sponsor. And as someone starting, where he should start to co-sponsor a deal. So I'll try to give my version of the answer, and then we can see Claudia, Martin, Paul, if you guys have any feedback. So Jay, I think I don't know exactly where your experience is right now, but what I would say is there's a few suggestions. Like, number one is starting with education. Make sure you really understand and get educated on multifamily, how to be a syndicator. Once you feel like you have the education down, then I would start networking with other sponsors trying to find other people who feel comfortable with you. And because multifamily is a team sport. So I always think of where can I add value to somebody else. So if you want to join a team, how can you add value? So there are a few ways you can add value. One is finding the deal. So maybe a co-sponsor that you work with is in another town, and you're finding the deal in your market. So you're the boots on the ground. So that's one way of adding value. Another way is maybe finding the money. So if you can raise money, then that's a great way that you can join another team in raising the money. And then perhaps a third way is maybe running the deal. If you already have experience running, you have experience with constructions, you have experience with running multifamily deal, but you've never had one, maybe you become what's called an asset manager. So those are perhaps a few suggestions that I have for someone starting. Claudia and Martin, what you guys want to add anything?
No, I think you're totally right. You hit it right in the head. Yeah.
Paul, do you have any?
All right.
Paul, do you have any?
I think what Marcelo said was really good. Find people that are already doing it, and just find some way you can partner with them. Even if they don't have a way to work with them now, I mean, surely you can learn something from them. How did they get into the business? What was their first deal like? How did they make the jump? If they did it 20 years ago, maybe the market was different then, but there's still got to be something that you can copy. You got to find people that are already doing it, and whether it means joining a club or there's also free groups around town, but you just got to keep networking until you meet people that you can work with.
Yeah, and everyone, I would say, everyone always needs help on something. Like, you're trying to get your first deal. Some months from now, we'll try to get our second deal. Someone who has 10 deals is trying to get to 20 or to 30. So someone is always figuring out, what do I need to do extra to get to that additional step? And for that, we all need some help. So ask, hey, what do you guys struggle with? What do you need help with? Even if I don't have the answer, but at least you know who needs what help, and maybe you need someone that can help them and make those connections, or maybe you can help. Yeah, just more hands. Yeah.
Yeah, absolutely. So let's talk about someone getting started as a passive investor. What's your idea and method for like looking at a deal and doing maybe some quick analysis on the deal and making sure it's something that you feel like you want to move forward with the investment? Paul.
Sure. I mean, today it seems like everyone's holding a webinar. Actually, 4 years ago, that wasn't necessarily something everybody did. So I think, it's possible to just convey all the information you need with a couple files that they can email you. But I like the webinar because it gives them a full hour to talk about the deal, and you just learn other details that you wouldn't have got, stuff that you wouldn't have asked about. You can kind of get a whole sense of where they got the property and what it's about. So hopefully they're holding some kind of webinar, because if you just ask questions, I mean, you might, even if you have good questions, there's always stuff that somebody, you get the opportunity to hear somebody else's questions and stuff like that. So that's the first thing I'd like to see. Are they going to make some kind of presentation? And then, you flip through it like, well, what do the numbers really look like? What's the story with the property? I mean, obviously the returns are the things you want. The returns are what you want to end with, but you really got to, how are they going to get those returns? They're buying this property for how much per door, and not that you should only look at that metric, but it's a good starting point. And maybe the very first question, so, I mean, assuming the first question should be, who is this sponsor? I mean, if you wouldn't be looking at it at all if it's not a sponsor you trust. So, I almost think that's a given. So maybe the next question is, well, where is the property? Because there's certain areas that, that are nicer than others. So you think, okay, I mean, if it's a bad area, that doesn't mean don't buy it, but hopefully they're underwriting for the problems that you have in a lower class area where there could be problems with where the demographics don't support a lot of rent growth, or if it's a class C- area, then are you accounting for a lot of delinquency and a lot of maybe vacancy and stuff like that? If it's a class A area, you might have to be, you're going to be paying a higher price, but your rents will be higher. You probably will not be able to push the rents because you're competing with brand new buildings. but does the underwriting account for that? So I do, basically, what is the property? Where is it? And what are you planning on doing with it? And I think if you can summarize that in a couple sentences, you get an idea of where it's going, but then you're going to have to dig deeper. All right, show me the numbers that you're going to do. All right, we're going to buy this property because the rents are under market. All the neighboring properties are charging much higher. Okay. So here are the numbers, and we're going to raise it by 10%, and we're going to raise the income by this much. And that's how we're going to get good returns. We're going to renovate half the units, and that way we can charge an extra $100, or we don't even have to renovate the units and we can charge an extra $25. We're going to do, I want to hear, what are they going to do to this property that makes it worth buying? Because today it's in a competitive market, you can't just buy a property and do nothing and expect to make a lot of money. Because what I hear is that even if a property has potential, a lot of times the potential is in the price. Like if you think you can spend $100,000 on renovations and increase your income by X amount, in a competitive market, sometimes buyers will pay that $100,000 up front. And so you're not really are you going to be able to make investments that are going to increase the value even more? In fact, the property I was talking about that had a lot of bad units, we didn't even renovate all of them. There were a couple that was it's going to cost $25,000 to fix up this burned unit. Even though we collect more income, we think the next buyer will just pay that $25,000. So why would we do it? Let the next buyer do it. So I want to know, does the property have opportunity to it, and we're not overpaying? Because I'm in a couple deals that aren't performing so great, and I don't think it was necessarily a bad property. I just think maybe we overpaid. So I just want to be able to, show me the numbers to show that this is a good price and we can get a good return, and that there's also a cushion in case the business plan doesn't work out. Either the economy slows down. Sometimes, you think you're going to start charging pet rent, and maybe the demographics don't really support that. People don't have enough pets, or none of the neighboring properties are charging pet rent. So it's not going to work. I want to see that there's that you can have, maybe some leeway, that if not everything in your business plan works out, you're still going to make a pretty good return. A lot of times, a couple of years ago, a sponsor would show us all these different things they were going to do, and they'd say, here's some additional opportunities that aren't in the underwriting. And today I feel that there aren't a lot of opportunities in the back pocket. You have to do all of them in order to get a good return. But I just want to feel comfortable that you don't have to that it's not shaky. If one thing doesn't work out, you're still gonna make a pretty good return. If you can't raise the rents by 10%, but you can raise them by 6%, am I still gonna make some money? And a lot of times I just ask, I ask questions on what they're planning on doing, and I kind of let them do the talking. And then whatever they say, I might have follow-up questions after that. So I don't necessarily have a long, detailed list of questions that I ask everybody. I have some basic questions like what I just said, and then when they answer the question, I start, okay, well, tell me a little bit more about that.
Yeah, that makes sense. Do you try to, you mentioned you went through your education there before invested. Do you try to underwrite the deals yourself and look at the rent roll in T12 and do your own analysis and then compare it with the sponsor, or you're just at a level that you just look at whatever they're providing at this point?
I would say I can think of a couple deals where maybe I should have spent a little bit more time on that. In fact, I did not do that in the beginning. I've decided that I want to start doing that now, and I just want to understand a little bit more about what the business plan is. So I have actually made it an effort. It's been a little while since I've made a new investment. I just I got tapped out on cash last year. So I've tried to give myself the time to, I'm going to use this time to get better at underwriting a deal. So today I do, I definitely look at the spreadsheet that they have to underwrite the deal. And I don't know when it becomes underwriting myself, but I definitely look at all the numbers and I start making changes to it. And I say, okay, they're going to raise the rents by 12%. Well, what if it doesn't go up by 12%? And I'll change it. I sort of stress test the deal. Like I do a worst case scenario. What if the rent growth doesn't happen? What if the additional income they're going to collect from pet fees or from charging for covered parking, what if that doesn't happen? What if expenses, a lot of times they have a plan to cut expenses. Well, what if the expenses stay the same? Or what if the expenses even go up because, the city underwrites the taxes, not underwrite, they assess the taxes even higher than expected. So I kind of I put the deal through all sorts of scenarios in the spreadsheet just to see, well, what's the worst thing that can happen? And, but what the second step to that is actually taking a better look at the T12 and the rent rolls and seeing, well, what is the owner really making right now? Is the current income do I understand where the money's coming from now? And does the transition from now to the business plan actually make sense? So I do want to get better at that. And so I did not do that on past deals. And that is my goal for the next one.
Awesome. I think we're almost running out of time. So I wanted to ask the attendees if you guys have any questions, anyone wants to unmute yourselves and ask a question, or if you want to put it on the chat.
Yeah, PJ, looks like you have a question there. Do you want to unmute yourself and ask for a question?
I think you muted him also.
No, I think.
Is he self-muted, or
Okay.
did you mute him also?
I can try to unmute you, PJ. See if you can, if we can hear now. Yeah,
can you hear me? Okay,
yes,
great.
Go ahead.
So from the passive investment, my question is, when you look at these different syndicated deals, is to what extent they are willing to share the information, like as we're talking about T12 underwriting to check what they have done, because typically in the webinar, they only have a snapshot of the overall. And so is it, that's what I'm trying to see. Like one syndicator I asked, look, they did not respond when I asked for T12 to verify underwriting. Can you give any, what is typical and what is not typical?
Like I said, I haven't always asked for that. I definitely want to start asking for that now. Ironically, a couple times I didn't ask for it, but I asked a question related to it, and they said, "Oh, here's the T12. I'll show you." So some of the sponsors have been. I guess I've never been refused, but I haven't always asked, and I do want to start asking. And my opinion is, if you want it and you want to see it, and the sponsor won't give it to you, then that's someone. I mean, you should only invest with somebody you're comfortable with. If they're not going to be forthcoming when you're considering investing, they're not. Do you think it's going to get better when you are an investor? I mean, what if the deal doesn't go well? Are they going to be forthcoming with what's going on? So I think you have to be comfortable investing in the deal. And I think that some sponsors will share that information and some will not. I've heard one or two say, well, they can't share it because the broker makes them sign a confidentiality agreement. And that's fine. I say, okay, well, give me the confidentiality agreement and I'll sign it. I mean, I think that would be the best response. That didn't happen to me. That was more like I was just talking to a sponsor and she was saying, what happens when people ask for that. I think if you want to be thorough, you should look at it. If you're comfortable and you trust the sponsor, you don't need to look at it, then maybe it's not a deal breaker for you. But if you want it and they don't give it to you, then I don't think you should invest. I think the sponsor has to answer your questions to whatever level you need to be comfortable. And I think
what about the underwriting? What about the underwriting model itself?
Yeah, I think I've had one or two sponsors tell me they didn't want to share their formulas. So I said, okay, well then give me a PDF, do a webinar, do like a Zoom session like we're doing right now and just show it to me. I don't need to see the background so much, but I want you to help me understand the numbers a little bit more. So I think, if they might not want to give you everything, but I think they should be able to share with you enough information so that you can understand it. And I think, I'll tell you, for their sake, I don't think they want an investor who's not comfortable either, because they're just going to give them problems. It's kind of a lose-lose. If you invest in a deal where you're not feeling totally comfortable, and the sponsor accepts an investor who's feeling a little nervous about the deal, then it's not going to end well. Unless the deal is a great success, then you don't have to worry about it. But if the deal struggles, I think both sides are going to regret it. So yeah, to answer your question, some share it, some don't. If you want to see it, then I think you got to find sponsors that are willing to share it.
Yeah.
What's the other
I agree.
opinion? Is it typical what you see? Is it people are willing to share, or I mean, as a sponsor, you also have different choices, a lot of choices to pick, right? If somebody asking too much, or it's maybe, I don't know, I'm just thinking they also have a option to pick and choose. They rather want to go with somebody don't ask too many questions, right? So that is less time. So that's what I'm thinking. Sometimes maybe is it too much to ask? That's what I'm trying to see.
No, I think you should definitely be comfortable. And for me, like Paul was saying, I totally agree. I think it would be a red flag if you ask and they say they can provide it. I would move on to the next deal. And in regards to the spreadsheet, the underwriting spreadsheet, I have seen sometimes where the sponsor don't want to share the raw spreadsheet because they're concerned that you may modify it and then that becomes your version of the truth and not what they provided. But in any case, they should at least be able to create a PDF version, like Paul was saying, and give you all the supporting details for the underwriting spreadsheet, but not just saying, no, I can't give it to you. And because for me, I would just move on to the next deal, honestly.
Well, thank you. Yeah.
All right. I think we're getting to our time limit here. So let me just share Paul's contact information here again. Paul, you provided a lot of good information. So Paul's email is here, and he mentioned that you welcome any additional questions you may have.
Sure.
And so with that, I also want to mention that if it's your first time here, we're meeting the first and third Wednesday of every month. It's typically at 7 p.m. Central Time. This time there was a conflict at 7, so we had to meet a little bit earlier. But come back and see us on March 4th. That's when we focus on how to do your first syndication. And then again, on the third Wednesday, we focus on being a passive investor.
Thank you for watching this week's episode of the Multifamily 0 to 1. Join us live the first and third Wednesday of every month.